All right, here we go. Episode 5, behindthevault.net. I'm Angelo Mancios, and with me as always, the producer of everything, Samantha.
Producer of everything.
Hi, Sam.
Hello, how are you today?
Very good, very good. So I'm super excited. I mean, for anybody that's been listening to our podcast and watching our videos on YouTube, we've been getting some tremendous feedback, which is great. But we're going to do something pretty unique starting next week, as we've got some guests lined up for our podcast. And, we're not going to spill the beans right now, but there's some exciting stuff coming down the pike. And I've been super pumped about it. So
we have some pretty cool people coming. So anyways, let's not say too much because we don't want to give too much away.
No, absolutely. But, so you want to talk about insurance today? We had our
let's talk about insurance. So we also brought it up a few of our podcasts. We brought it up before that we're going to talk about it. So here it is.
Here we go. Right.
Waiting with bated breath.
So well, insurance is one of those topics where I find that there's a lot of people out there that don't see the value in it. Right. I've seen many people who've written financial books saying, you don't need insurance, or, you'll go to a bank and they'll be like, you don't need insurance. And I sort of wanted to debunk some of the myths around insurance, because I found in my experience that people either have too much, too little, or the wrong kind. And they fall into one of those three categories, right? And the education, I think, around insurance is really weak. It's the kind of thing you wish you had when you needed it, but, and it sucks to pay for, right? Because it's not tangible. And that's the biggest criticism I get is it's not a tangible thing. It's not like an apple that I buy an apple and I can eat it, or I buy an iPad and I can play on it, or, I buy a car and I can drive it. Insurance is just it's a promise, right?
Yeah.
It's a promise of, hey, if you give me so much money a month, if something happens, I promise to give you this. And, and I can see people's sort of hesitation around that. But, I've always said in the last, 12 years that I've been in the industry, it's better to have it and not need it than need it and not have it. Yeah. And I tell you, as an advisor, when I show up with a get well check, or, I show up at a funeral with a check, people usually prefer that over a get well card or flowers, right? I mean, insurance can save somebody's assets. It can save their retirement. And that's really where my focus is, right? Is okay, I get it. If you're in a situation where you've got some debt, or you've got a mortgage, you need to cover it off with some insurance, or, we're not really talking about home and auto. I mean, you have to have home insurance if you've got a mortgage. You have to have auto insurance if you drive a car.
Even if you're just renting, you still have to have home insurance.
Let's start with life insurance, and then we'll get into critical illness, disability, long-term care, some of the other specialized programs that are out there.
Now, would you say that in kind of order, you think life insurance is the most important type of insurance to have?
No.
Let's take away homeowners. Let's take away the auto, which is
there are lots of times where I've told people you don't need life insurance, and it's funny because my contract was with as an advisor. For the first 8 years of my career, I worked with a big insurance company. And whenever I would say things like, you don't need life insurance, I'm sure somewhere an executive shed a tears, right? And it's like, what is he saying? Everybody needs insurance. You know what? Look, here's the thing with life insurance. And it's my personal belief is that if you have assets or dependents, you need life insurance. Right. So if you've got children under the age of 18, you absolutely need life insurance. That is a non-negotiable. I will not waver on that. I don't care if you got to borrow the money to do it. And that's a super bold statement. Yeah. But your children cannot defend themselves if something goes wrong. They can't. Right. Like I've got my kids are almost 12, 10, and 8. So something happens and daddy goes down and then mommy goes down, touch wood, it doesn't happen. What are these kids going to do? Right? Okay. So you have a family member that says, hey, I'll take your kids if something goes wrong. No problem. I'll raise them. Okay. So my sister, who's got 2 kids, who's the guardian of my children if something happens to their mother and me. Well, are they just going to show up with like the clothes on their back? And now my sister, who has 2 kids of her own, has to now house and feed and raise 5 kids.
Yeah, who's going to pay for them?
With no financial help. Yeah. Are you kidding me? Those kids better be showing up with a bag full of money over their shoulders saying, hey, auntie, hey, uncle, I'm here. And don't worry, I brought cash, right? Yeah. So, and, we can get into the dynamics around how that money is distributed. I'm a big believer that you don't just hand over that check to the guardian. You put it in a trust and you drip that money out on a monthly basis. And then, of course, you make exceptions for things like medical, school, and outstanding, like outrageous expenses that, you don't really think of. I would rather, the guardian of my children get, say, $3,000 a month or $5,000 a month to raise those kids, which you don't need that much, but whatever the number I choose, versus go, here's a check for $1 million. Because, you put that kind of money into somebody's hands and they could be the most, like my sister is one of the most trustworthy persons you will meet. Or people you will meet, persons, and I would have 1,000% confidence that, she would raise my kids and all 5 kids would be treated equally. I got no worries there, but not everyone's like that. And what's interesting is, money makes people do crazy things. You put a check for $1 million or $2 million or $5 million into somebody's hands, then what, right? So think about a child who's maybe 19 years old, loses their parents in an accident, right? Man, if you'd have given me $1 million at 19, I would have spent that money way differently than, in my mid 40s, right? So.
Well, and if you're not used to having that, like someone I know was given 100,000 and they live a lower income life. And they had no idea what to do with it. And I mean, if I was to get that, I would jump right at, throw it into my TFSA if I have money left, throw it into, my RSPs, throw it into somewhere, or any type of investment that's going to make me money back. Like that's my third, maybe, pay off something I need to pay off or whatsoever.
Sure, it's a balance, like we always talk about.
Right? Yeah. But they went through all the money and it's gone. Bought a new car, bought toys for their kids, bought all this stuff. And now they have no money.
Right. However, they would have invested that money and it doubled twice over 20 years. 100 becomes 400. They leave it another 10 years, it becomes 800. And there's a sweet, nest egg for your retirement, right? So, but what's interesting is, and we're going to get into that in a future podcast. We'll do about estate planning and really how to structure it. But so, circling back to insurance, there's really 2 types of life insurance you can look at. There's term and there's permanent. Now, term insurance, it's like renting, right? So you can get a whack of coverage and the cost is really low, but every 5 years, 10 years, 20 years, 30 years, depending on the term of the policy, the price will change. So, typically people, when they buy a house, they have a 25-year mortgage. They'll look at a term 20 life insurance policy to cover off the mortgage. Circling back, there's 2 types of life insurance we can talk about. There's term insurance and there's permanent insurance. So term is a temporary option. Think of it like renting, okay? Now with term, the number that follows the word term is the number of years that the price is locked. So like a term 10 means the price is fixed for 10 years and then it automatically renews at a higher price. And then you pay that price for 10 years and then it automatically renews for a higher price and so on and so forth. A term 20, the price is fixed for 20 years and then it automatically renews at a higher price for the next 20 years. Right. Typically these policies will expire, at about 80 or 85 years old. And past the age of, dare I say, even 60, those things are stupid expensive because the probability that you're going to die in your 60s is a lot higher than in your 30s. That's just simple. It's just simple common sense, right? Yeah. So as you get closer or as you get older, the insurance company goes, oh, there's Iris, this guy's going to die or she's going to die. So we're going to charge more.
They also lower it as well. That is something that I actually didn't know, is that as you get older, I mean, maybe it was just the specific plan that at least my dad had, is I know once he turned a certain age, the amount that he would have
The
been given,
coverage goes down.
the coverage goes
Yeah.
down.
So with term insurance, yeah, it depends on how the policy is structured. Some policies, what they do is to keep clients paying premium, they'll lower the coverage amount to keep the price the same. So you
Right.
get to say 65, and let's say it's renewing again, and the client's like, well, I'm not going to spend $1,000 a month on insurance. What can I get for the 300 I was paying? Oh,
Yeah.
okay, the coverage is lower, but I still have some coverage. This is fine. But you got to also think about this. The ideology is that as I get older, I'm building my wealth. I'm paying down my debt. My net worth
Right.
is higher. Like,
Right.
hopefully, in all the other areas of your financial plan, you're making strides. You're not going into more debt, right? Like, you're paying down that mortgage,
Right.
right? Even though it doesn't feel like that in the first 5 years, you're starting to pay that down by year 25. Like, by year 20 into a mortgage, right? You may only have a small bit of it left over where you're like, whatever. My partner or whatever they'll cover it. Their income can cover the last 5 years of payments, even if they take that small chunk and restretch it out over 25 years. Who
Right.
cares? Now their payment's like $400 a month. I don't need the insurance, right?
Yeah.
Or if let's say, my situation that, I get to 60 and, my kids have moved out and they've got their own lives. And I'm like, well, if I die, right, they're just going to sell the house and pocket the difference.
Hmm.
So, like, who cares if there's a small mortgage on it or whatever, right? I don't need insurance for that. So typically what will happen is people will carry term insurance for the duration that they have a mortgage, they're raising children, like a temporary need, right? They've got, even student loans, right? Students will ask me, should I buy insurance to cover my loan? And the question I ask them is, do your parents co-sign on the loan? No. Then you don't need insurance, right? Because if you die, your estate's bankrupt. You've got no savings, you're young or whatever. If you die, so what? And I'm not suggesting that's how you get out of student loans, but
But they'll
if,
take any equity that you have, though, no, correct? Like, they'll
of
take
course,
any, I
sure,
know,
any
for
savings.
example, yeah, when my uncle had a balance when he passed away, he had a balance on some of his cards or whatever. And luckily some of them were covered in insurance, but the rest was the balance that whatever was
No, the
not
estate, listen,
covered.
the estate has to settle all debts before anybody can get
Any money or
inheritance or
anything.
whatever,
Yeah.
right? But if
Yeah.
I'm 22 years old and I've racked up a $60,000 OSAP debt, right, or student loan debt, and I have no savings, I didn't get, and something happens, God forbid, and I die,
Yeah.
right? Well, what's going to happen? Debt does not roll to the next level, right? So you can't
Mhm.
inherit debt in an estate. You can inherit assets, but you can't inherit debt. So what'll
Right.
happen is whoever winds up the estate will go, okay, so Johnny had no assets and owed $60,000 in student loans. So this estate is bankrupt.
But
There you go.
that's what I find really interesting, is some people don't understand that, is that you have to pay off any debt like with the assets, and people will be like, oh, but like my parents left me a house. Okay, but what if there was
Yeah, but
like
the house
a
has a mortgage.
200, but what if there was a mortgage or a $200,000 line of credit taken out on kicking out on the
Mm.
house? That's got to be paid out. So you can't just keep the house. You have to sell. Well, most of the time you have to sell that, unless you're going to buy out that. You have to sell the asset to get the money to be able to pay off,
The
that
debt.
whatever line or
Right.
whatever's
Unless you
left.
can qualify for a mortgage or a line of credit, right? So
Yeah, of course
like
there
if
are other options.
mom
Yeah.
and dad pass away and there's $1 million house with a $200,000 mortgage, right? If I can assume that mortgage, if I've got the income to do it or I'll collateralize the house, the bank will be like, knock yourself out. But if you don't make the payments, we're going to foreclose, right? So
Mm-hmm. Mm-hmm.
so with term insurance, it's typically used to cover a short-term need, right? So young
Right.
children, new mortgage with a partner, right? One thing I tell my clients is this, when it comes to insurance, you have to have sort of a common understanding of what you want this insurance to do.
Hmm.
Most commonly, you know, what couples say to me, they'll say, listen, if something happens to me, I just want him or her to have no debt and a fresh start, right? So
Hmm.
let me paint the picture. So you buy a house, you have a couple kids, and let's say you owe, I don't know, 400 grand on the house, and the kids are under 5 years old. So you know you've got another sort of 15 years to raise, 10 or 15 years to raise these kids, plus you got to put them in school, right?
Hmm.
So if the two of you together with your incomes can take care of that, if you remove one person from the picture, now you've got that surviving spouse, whether it's mom or dad, that has to now carry the burden of the house, the kids, and all the expenses by themselves. So, what the point of insurance is to replace that person's future contribution to the family, right?
Hmm.
So, for
Hmm.
example, if let's say you made, I don't know, 70, 80 grand a year, right? Let's say you were a teacher or something like that. I don't know, just pick a profession, doesn't matter, and your spouse passes away, well, if the house is paid, the education money for whether it's private school or university or activities, even for the kids, is already in the bank. And you've got a little sweet chunk just to help raise those kids. You can raise three kids on a, or two kids on a teacher's salary if you've got no mortgage and education's already banked.
Yeah.
That's easy. And that's what insurance does, right? Now, what some brokers will do is they'll say, hey, Mr. and Mrs. Client, how much money do you make? I make 100 grand. I'll use 100 grand for easy numbers. I make 100 grand a year. And they'll go, okay, well, if you had $2 million and that $2 million made 5% rate of return over the next, or whatever, that's $100,000. So you should buy $2 million of insurance. Boom, right? Or you go, I make 100,000, but after tax, I really bring home 70. Okay, well, how much money would you need to put into an investment? I don't want to say into the bank, into an investment at 5%, which is a very conservative rate of return, to replicate that person's income. If I can
Hmm.
replicate that person's income with insurance, then you know what the benefit of that is that the surviving spouse doesn't need to jump into bed with the next Yahoo that he or she meets because they need financial support,
Right.
right? There's that desperation and that stress is gone. And that's what I tell clients. I say to them, listen, put yourself in a position that if one of you was removed from the situation, what would you want for the other? Right? And then you get, you get some people that are like, like Homer Simpson would say to Marge, Marge says, Homer, if something ever happened to you, I'd never remarry. He's like, you're damn right. I want to be stuffed and mounted on the couch as a representation of our forever love.
Yeah.
So,
Anyways, going back
so
to
getting back,
insurance.
yeah. So, yeah. So what I tell clients is that if you were removed from the situation, how stable would you want your family to be without you? Right?
Yeah.
So, and think about that. So, yeah, I mean, if something ever happened to me, I don't want my kids to suffer. I mean, as a parent, my responsibility is to raise those children, dead or alive, dead or
Yeah.
alive. I'm not just gonna be like, oh well, I died. Okay, oh, well, that's life. So what? No, man. Like you got to raise those kids, right? There needs
Yeah.
to be like we live in a world, especially in North America, where you need money to do most things, if not all things. So, like I can't in good faith, in good conscience, do nothing. So I'll tell you
Yeah.
a cool story. So my really good friend, Mike, who was a bit of a mentor for me when I started in the industry, he works downtown Toronto, and he was telling me this story where his best friend, um, he had a 4-year-old daughter, and his wife was a stay-at-home mom. And one night, it was a Friday night, he was over at the house and they were watching the hockey game. And my buddy Mike's a big Oilers fan. I don't know how that happened, but we won't get into that. So they're watching the hockey game. The 4-year-old's bouncing on her knee, and the buddy's like, "Yeah," he's like, "I don't even have insurance." And Mike turned to him and went, "Wait a second, you got a 4-year-old daughter? You don't have insurance? Are you crazy? Your wife's a stay-at-home mom? You have insurance in case something happens to you?" He's like, "Oh, what's gonna happen?" He's like, "I don't know. You could die,
Anything?
and you could leave them out, and you can leave them out on the street." So Mike went to his car, grabbed his computer, And, you know, he was pretty aggressive because it was his best friend, opened it up and said, you're going to buy a policy right now. And I'm not even contemplating an argument. So he wrote up like a $500,000 policy for him, right? Got the void check, whatever, right? So this was Friday. Sunday, dude is driving down the QEW and doesn't a tractor trailer go poop and topple over and crush the car instantly. Okay. 2 weeks later, the wife had a check for 500 grand from the insurance company because the guy would have qualified. Well, he died instantly in that crash. Instantly. So the widow says about Mike that she was the angel on her shoulder. Like she's like, you know, some higher power possessed him to go, are you kidding me? You don't have insurance on your dog? Like, you kidding me? And you know what? It was such a touching story because you just never know. Like,
See,
your life
I was always
on a dime.
When I was old enough, I mean, I don't have kids. Like my life insurance is going to my sister. Like that's like,
well,
that was for now, of course, for now.
For now.
But that was one thing that once, you know, I was a little more solid in my career and had a little more money that I could afford to do that. That was one of the things was you should get life insurance because you don't know, like you literally don't know what happens. And it just helps your family. And the thing is Heather and I, at this point, we're both single and we're like, okay, I'm the beneficiary of her. She's the beneficiary of mine. And it's just something you should have, because you can also get a lower rate by starting it earlier. You get, you know.
Yeah, you know, and you can lock in your health earlier. And listen, I hear all the reasons as to why people should buy life insurance early. And I'll tell you that 95% of the reasons are made up so insurance guys can make sales. And I hold no bones about that. And let me give you an example. Of why I believe this.
I mean, I also, before you kind of validate your point, the reason was I was also just coming off my dad who had passed away. And if my mom did not get the insurance, that's the reason why I was like, you know what, let's get this started and let's, you know, do that. Anyways, go ahead as to why.
Totally. So here's the thing, right? I think a lot of it is, you know, when you're doing financial planning as a whole and you're looking at the big picture, you have to ask yourself, or one thing I ask myself is, what's the ultimate goal? And what are the different scenarios that we can encounter? So let's take you for example. If you would have come to me 2 years ago, 3 years ago, 5 years ago, I would have said to you, okay, Sam, you're single. Yep. You got any kids? Nope. You have any dependents? Nope. Other than my dog. But, you know, unfortunately, in the eyes of estate planning, in the eyes of estate planning, your dog is not a dependent. So if you were to pass away, who is financially affected? Well, the answer is no one. Nobody is at a financial loss. Now, maybe somebody has to like bury you and do a funeral. So maybe you could argue there's like a $20,000 funeral expense.
I think that's why as well.
I'll give you that.
Yeah.
I'll give you that. Okay. But hear the other side now. But let me ask you this question. Let's say that you're single, you stay single for a while, and you're working, and let's say you make great money. Let's say you make 80 grand a year. I'm just making a number up. Okay. Let's say something happens to you and you get cancer, heart attack, stroke, you have bypass surgery, you know, you have an organ transplant, an illness, something happens, a disability, and you cannot go to work and earn. Now what happens is you become, I hate to say it like this, but you become a burden, not necessarily financially for somebody, but now somebody needs to take care of you, right? Yeah. And guess what? You're still alive. The bank's going to be like, hey, I need my mortgage. I don't care. Or the landlord's going to say, hey, I want my rent. I don't care. Yeah. So what I tell people who don't have dependents and don't have major assets yet is maybe look at critical illness insurance first, and life insurance second. And if you had to choose between the two, buy the critical illness, because God forbid something happens to you, or the disability. God forbid something happens to you and you can't earn. Yeah. How are you gonna pay your bills? So what are you gonna do? Call mom and dad? Not everyone has that luxury. And number
Yeah.
two, are you going to move home with mom and dad? So now you're going to saddle somebody else with the burden of
Yeah.
taking care of you, right? And there's no money coming in. So I would say that in that situation where there's no kids, no dependents, no spouse, right? And nobody's affected if you die. Well, let me tell you, it's this is a self-preservation move. I would look at critical illness
Really.
first
Yeah.
and life insurance second. And you'll say, well, I may not qualify, but listen, the probability that you're not going to qualify for life insurance when you're 30 and you buy a house is really low. Or sorry, is that you're not going to qualify is low. It's low.
Yeah. So I had that happen to me where and this was before I got it, I had ended up having to go in for emergency knee surgery. I tore my ACL and meniscus. At this point, I was solely teaching acting and dance classes in person.
There you
And that
go.
was my full income. And I
Right.
completely lost all of my income because obviously it's a contract position. You can't work. You don't have any money coming in and
Yeah,
like I had some
entrepreneur.
savings, but I was in a really rough place. So I actually, thank goodness it hasn't happened since, but I had that happen where, I was out for 10 weeks of work, 10 weeks of work.
Yeah.
And that is a lot. That is rent. That is, food. That is a
Two and a
lot.
half
It
months
was
of rent, food.
very stressful.
Right.
Plus
And if
physiotherapy.
you
Let's
don't
talk about the
have,
physiotherapy you have to pay for,
sure.
you know?
Well, and like it comes back to having some savings and the importance of saving 3 to 6 months of monthly
Totally.
expenses.
Yep.
So that if stuff does go sideways, you've got some
Yeah.
short-term temporary.
Totally.
But
Absolutely.
let's take it a step further. What if it was a stroke? And what if you were paralyzed on one side of your body and it took over a year for that sensation to come back, and then another year of physio to get back to where you were before? Imagine being on the shelf for 2 years. Look, there are illnesses that will slow you down. My bypass surgery, it slowed me down, right? Like I didn't work from December. I didn't work in January. I was still able to take calls. My mind was still sharp. I slept a lot because I was healing, and I slowly went back to work in February, like a few hours a week, and then slowly ramped it up. But that's because I was eager to get back and I loved what I did and all that stuff. My doctor's like, dude, you should take 6 months off. I'm like, 6 months? I can't go 6 months without working with my clients. That's no. And it wasn't it's not a physically demanding job, but mentally it's exhausting. So, I made that decision. But, a bypass will slow you down. Breast cancer or prostate cancer will slow you down, right? Like it's not going to stop you in your tracks, but it will slow you down. Heart attack.
But you don't know. It depends.
Could stop you, could slow you down.
It depends what stage you are. It depends on so much stuff.
The good thing about critical illness insurance is it's a policy you can buy that is tied to your health. So if something happens and you live 30 days after the incident, you're going to be presented with a check, right? So, whether it's 100 grand or 250 or a million or whatever you choose to buy, right? I think in Canada, the maximum you can own amongst all your policies is $2 million of critical illness insurance. So, what that did for me is after my bypass surgery, 30 days later, I put in the application. 3 weeks later, I got my critical illness check. And boy, was that a lifesaver, because I was able to pay off some debt. I was able to, put some money away. And it gave me the opportunity to just not feel forced back to work. Right. And listen, if you're going through something traumatic like a heart attack, cancer, stroke, bypass, the number one thing that will hinder your rehab is stress. And financial stress is the worst. I had a client, I remember my first year, I sat down with him, guy's in his mid 40s, making good coin, 3 kids, wife was working. He bought life insurance because he needed it and she needed it too. And they got for the kids as well. We're going to talk about, the pros and cons of that. And then I showed him critical illness and he's like, I don't need that. Okay, fine, no problem. In January, so this was November, in January, first day back, January the 2nd, I get a phone call. And he's like, hey, can I still buy that critical illness stuff? So I'm like, what happened? Like, I'm thinking somebody had a heart attack. And he's like, well, my next door neighbor, 33 years old, had a stroke over Christmas. And they don't have any savings. They don't have any They're really high in debt. They had no insurance. And
Wow.
the woman is literally dragging her husband to the car and carrying him up the stairs to the office. The guy works in IT or whatever. And he's dragging himself to work because they don't have another choice. He's like, I don't want to be that guy. I want to be in a position that if something happens to me and I go down or I'm on the shelf for a while, I've got backup. I'm like, all right, I'll be
Yeah.
over soon. So,
Yeah.
now the cool thing about critical, and this is if by age 65 or 75, depending on how you structure the policy, if you don't claim, you get your money back. So it's like a forced savings. Now you don't make any
So
interest
that
on that
that
money
that happens with some insurance companies and insurance plans. Is the pot, if the pot's not
with life
used,
insurance.
yeah, with life insurance,
Yeah.
it yearly, if the pot is not used, they'll actually give money back to everyone, regardless of how, like, or depending
Right.
on how much
Now
you've actually put into it.
you pay a premium for that, right? So as an insurance advisor, you've got to balance, and as a client too, you've got to balance do I buy more coverage or do I buy more bells and whistles? So like, how does
Mhm.
it work? If I'm going to spend, let's say, $100 a month on insurance, should I buy 2 million instead of 1.5 million, or do I get 1.5 million? But hey, if something happens, I get all my premiums back, right? Like
Yeah,
you got to see what's going to be a
balance.
better
Yeah. What's the better option for you
balance,
for
right?
sure?
So the other kind of life insurance that we haven't talked about is permanent insurance, and there's lots of talk around permanent insurance, whether it's whole life, universal, or just what I call cheese pizza plain permanent insurance, where you pay this, you get that, and there's no bells and whistles. I'm a huge advocate of letting the insurance company pay the tax bill at death. Huge. If I know your estate's going to have a $500,000 tax bill, I'm going to encourage you to buy $500,000 worth of life insurance, because you're not going to pay 500,000 in premium. You're going to pay less, even if it's 400, even if it's 300, right? Over a 20, 30, 40-year period. Well, the beautiful thing is that you're leveraging that, right?
Mhm.
It's like, I'm going to pay, 300,000 in premium or 200,000 in premium. The insurance company is going to pay my $500,000 tax bill, which means my kids get more money. That's a
Right.
wealth building strategy, right? So after the temporary stuff is done, house is paid, kids are grown, or there's money in the bank, and I'm good there. How can we use insurance now to grow our wealth? And there are so many options out there with whole life, with universal life. Universal life works just like a supercharged TFSA, right? You can overfund it with investment dollars. You can shelter that money and grow it tax free, and then deal with the tax at retirement. Well,
Hmm.
at retirement, my taxable income or my tax bracket should be lower, right? So that's a great way. So think about it this way. It like a TFSA, all that money goes tax free. So if my $100,000 becomes 700,000, I pay no tax on the difference.
Mhm.
Well, if I've got to pay tax along the way, right, my growth opportunity is lower because I'm peeling some money away every month for tax or every year or
Right.
whatever. Whereas with a universal life policy or a whole life policy, when you're overfunding it and you're jamming cash into that, well, now I can grow that money untouched, tax free, or tax deferred, really. And if I die, all that insurance plus the cash goes to my beneficiary.
Hmm.
Or what I can do if I'm alive and I want to use it, I can borrow against it, or I can just pull the cash out of the policy and use it for retirement income, right? So it's another bucket that you can create, and leveraging the insurance company that makes way more money than most people. Never a bad idea. Like I've got clients that have tons of real estate and they've got properties, and when they die, guess what? There's going to be a huge capital gains bill on all those properties. So
Mhm.
when I say, and their biggest conversation with me is, well, hang on a second. He goes, I'm going to pay like $1 million in tax, because I got all these properties. Uh-huh. But I
But
want my kids to have it.
they're updating that too. That there's a big thing about the fact that they're changing that
Yeah,
recently.
listen, if they change it, it means the government's going to take more money. Don't kid
That's
yourself.
they're
They're going to,
they're changing,
yeah,
no, they're changing it in a negative way for us. They're upping it even
right.
more. That's the big
Of
thing that's been
course,
going around in
right?
the news.
Well, because the thing is with capital gains, you're only paying tax on half the growth, not all the growth, right? With income,
Yeah.
you pay tax on all the growth. You make 100 grand, you pay tax on 100 grand. With capital
Right.
gains, you make 100 grand, you only pay tax on 50, right? Right.
Right.
So where life insurance has become, a big topic of debate is, some people believe, and there was a book that was written, I forget the author, where he said, buy term and invest the difference. Permanent insurance is a waste of money. You should buy it. Well, you know what? Permanent insurance is not a waste of money if you're buying it for the right reason. But if you're buying it because some life insurance agent is trying to make a quick buck and doesn't really understand or have a plan for that policy, then yes, it's not worth it. Right. And by
Right.
the way, on a side note, you can buy term and invest the difference, but most people don't invest the difference. That's the problem.
Yeah.
Right. They forget that
Okay. So,
piece. Right.
so there's a lot of information over the last like 40 minutes. So can you just can we summarize it? Because even there's so
Sure.
many
Let's do
different
that.
places talking about it. So let's summarize
Absolutely.
kind of what we've walked through for those of us listening, just because even with me, like I'm so engaged with what's going on, but I'm like, there's so many different sections to cover. So how can we
Listen.
summarize this one?
Okay. So I've always said that life insurance is like the defense in your financial plan. Okay. Chances are it's not going to make you a ton of money, but it's going to prevent the money that you have and the wealth that you built from collapsing.
Right.
Okay. So as an example, somebody gets sick in the family, like my mom did at 41 and can never work again. And then you pull all your assets out because you need that for income, and you miss all those compounding years, or it side rails your retirement. There will be bumps in the road, ladies and gentlemen. People are going to get sick. People are going to lose their job. People are going to get hurt. Like, that's life, right? COVID may happen. And, we talked about, COVID is like
changing.
knowing what retirement looks like, right? Retirement is not working and living off your savings. So when you're looking at insurance, ask yourself this question: what do you want the insurance to do? If it's a temporary need, like your mortgage, right? And by the way, you should never buy the mortgage insurance at the bank. You should always get proper life insurance, term life insurance. Number one, it's cheaper. Number two, the value of the benefit doesn't go down. Number three, you have options. So you can give that money, or, you can name a beneficiary. The beneficiary is in the bank, right? And there's a 100% chance that pays out because you've pre-qualified with medical. Whereas at the bank, you do the medical after the fact. And let's just say not every policy pays out, right? Okay.
So try not to use the bank. Yeah.
No, don't use the bank.
Yeah, don't. Sorry,
not try not to.
Okay.
Don't use the bank.
Don't. Okay.
Use the bank to get the mortgage. Use the bank for your savings account. Use the bank for the things the bank is good at. But you don't get Chinese food at a Greek restaurant.
Right. Okay.
You don't buy insurance at a bank. You buy it from an insurance company. That's, So with term insurance, you want to use that to take care of things like your mortgage, kids, any debt that you have, any short-term needs that eventually are going to go away. Right? You're not going to raise your kids your whole life. You're not going to pay for school your whole life. You're not going to pay a mortgage your whole life. So those needs are going to shrink and eventually disappear.
Right.
Permanent insurance is for the inevitable. Guess what? We're all going to die.
Yeah.
That's it. It's going to happen at some
spoiler.
point in our lives. Yeah. Spoiler alert. At some point, you're going to close your eyes and they're not going to open again. And that's okay. So what you want to ask yourself is, when that event happens, the final event, what do you want to see happen after that? How do you want your family, your loved ones, your charities, your churches to be impacted by your death, positively or negatively, right? So then we talk about the young couple that's got a young family and one of the people dies. Well, what are you going to do? Right. Yeah. Or we talk about the successful business person who's got a bunch of properties and wants to give those properties to her children, but doesn't, but there's a huge tax bill that's coming. Right. How can we use insurance in the later years to build your wealth and to benefit your family or church, and I use church universally, or charity? Like, you can leave. Listen, I know lots of people that will leave gobs of money to their
Well, and
church,
we
their
actually we talked
synagogue,
about
their
that.
mosque. Yeah,
We
we had
talked
that
about that
conversation.
in our first or second podcast. We walked through people who
Right.
choose to do that. Yeah. Yeah.
Absolutely. And it's such a wonderful thing to be able to do, right? And it doesn't have to be a big glamorous, organization. It could just be like a local women's shelter or a local
Right.
orphanage or the pet the pound or what SPCA or whatever it's called, right?
Right.
So with life insurance, ask yourself, what do you want the insurance to do? And then plug and play accordingly. With
Right.
critical illness and disability insurance, those policies are designed to ensure that if you can't go to work or you can't earn and you're on the shelf due to an illness or an injury, there's still
That
money
covers it.
coming in,
Right.
right?
Right.
And you know what? It's become very sophisticated. Critical illness is my favorite policy. I mean, I claimed on it, right?
Yeah.
And listen, the probability between 18 and 65 to get a critical illness is 50%. So flip a
Yeah.
coin. Heads, I get it. Tails, you don't. Right?
Yeah.
Or heads, you get it. Tails, I don't. So, and if you don't claim, you get your money back. Like that's a great policy to have, right? With disability, same thing. Now, the big thing with disability and where it differs from critical illness is that disability is tied to your ability to do your job.
Right.
Whereas critical illness is just tied to the fact that it happened.
Yeah.
Right? I had bypass surgery. That's indisputable. 30 days later, I'm still alive. Pay me. Done.
Yeah.
Whether I go back to work a day later, a month later, a year later, or never is irrelevant. Whereas with disability, they want you
Very
getting back to
specific.
work. Very
Yeah.
specific, right?
Yeah. I know. I think that's what I actually have to. It's funny. I was talking about this today. I'm like, I actually have to check, which sounds terrible. I have to check because I think I went for the disability because of just my circumstance within that happening. I don't think it's a critical illness. I think it's disability due to any of the knee issues because I have been out of work multiple times and this was before I did more of kind of like the producing aspect. It was when I was actually physically active more
working.
so.
Yeah, totally.
So it did. So
and now, like I know, not to plug here, but like Capital has come out with a great disability program where you can get $3,000 a month of coverage without submitting income.
Right.
So if you're a stay-at-home parent, if you're somebody who is in a low-income job like a cleaning lady, and not say that what I mean by low income, I mean some people work for cash or
yeah, of course.
And not that I advocate that, but just if you're in a position where you are in a physical job that you absolutely need to make ends meet, then this is a great policy for you, right?
A lot of artists. I mean, think of artists. A lot
that's
of
a
artists,
great one. Dancers, artists, hairdressers, typical jobs where disability companies won't insure because maybe the income isn't very stable. Well, this policy debunks all that. It's like, here's $3,000 a month. That should be more than enough to cover your rent and food and basic expenses. And hey, if you want to show us income and stability of income, we can give you a much richer policy. No problem.
Yeah. No,
but
exactly.
You know what? There never really has been a situation where you can pre-get a policy, of that kind. So that's a great thing to look at.
So what is kind of, just to like wrap all of this conversation up, what is like your final thing to say to anyone listening to this?
So what I would say to you is that, offense wins games, defense wins championships. And that is a quote in sports that is known in any sport. Well, your financial plan, offense wins games, right? Hey, I had a great year in the market this year. Let's go on a trip. Hey, I was able to make, this property value went up and that was really great. My net worth is higher. Yay. But if you have no defense, right, and something happens that you don't expect, like an illness or an injury or death, premature, you're screwed. You could be in a really terrible, terrible position. And if you're in a job that's fixed income, right? Like if you're in a salary job where you can't control your paycheck, that's even worse because now you can't go to your boss and be like, hey, listen, my wife can't work anymore and she was making $90,000 a year. So can I get a $90,000 raise? Yeah. Your boss will be like, are you kidding me? Right? I mean, like just me saying it is ridiculous, right? So defense wins championships. Don't overlook insurance in the early years to protect your income. don't slough it off in the later years as a way to build your wealth. It wouldn't be the first wealth building tool that I would recommend,
Right.
but it would be up there. Okay.
Good.
And look
Yeah.
at all your options. The other thing I would say, as a final note is get a few opinions, right? Guys and gals that only sell insurance will solve every problem with insurance. Guys and
Right.
gals that only do investments will
We'll solve
only
every
solve your
problem that.
problems with investments. Why? Because it's how
Right.
they get paid, right? So there's a
Right.
little bit of bias there, right? Look at all the options that are out
So you
there,
want to
get a
and
few
find someone
opinions,
you trust, right? And
find
and
someone you
and figure out
trust.
the best option for you. Right.
Absolutely. And we'd be happy to help give you an opinion. So you can go to, behindthevault.net. You can email
Yeah.
us or comment
Send us
below.
an
And
email.
we
Instagram. We
will,
have an Instagram.
sure.
Instagram, we're on our
And we
messages all the
will,
time.
and we will happily give you an opinion with no pressure to do business with us. If you want to take that opinion and go to your broker or go to your insurance person, I'm okay with that. No problem. Because like I said right at the beginning, people either have too much, too little, or the wrong kind.
Yeah.
Very few people that I meet when I look at their overall financial plan have the right amount of insurance.
Yeah.
Very, very few. So be proactive, be defensive in your mindset, because I'll tell you this, I could be you could meet the greatest investment advisor in the world that could make you 25% return on your money every year. You get sick, that money's being pulled. You have a spouse pass away, that money's coming out, right?
Right.
You
Yeah.
cannot outperform a premature death, a disability, or a critical illness. That's it.
All right. So we'll leave that there.
And you've been behind the vault.
See you next time.